Fixed income investors are always interested in earning the highest yield they can for their risk appetite. And what you've seen in the developed economies in the US and Europe and Japan for really the better part of a decade is very low interest rates, and those are deliberately low interest rates as a matter of monetary policy. So fixed income investors have looked for higher yielding investments, and one of the places they have found higher yielding investments, again, with greater risk, is emerging market private debt as well as emerging market sovereign debt. The other area that has been very popular for higher yielding debt is the oil sector. Really what you have now is nearly the perfect storm of a slowdown in the emerging economies, as well as a significant reversal in the fortunes of oil companies, both in the US as well as in emerging markets. And that is going to have an impact on how the investments of fixed income investors fare, folks who have piled into higher yielding debt. Some of this is going to be very difficult to unravel. We had a brief taste of this in the late 1990s with the Asian financial crisis. The patterns we saw 20 years ago are likely to be repeated, where you have issuers in Southeast Asia and Latin America really restructuring via various tax-friendly domiciles in the Cayman Islands, Bermuda, Luxembourg, etc., and investors who might well be located in the US, in Western Europe, pension funds, mutual funds, and the like. So that's one set of issues. You have another set of issues with investors who are indirectly exposed. So you may well have a restructuring that takes place in Thailand, for example, with the Cayman Islands finance subsidiary. But for a particular set of investor who's exposed to those risks, that exposure may be entirely through a US mutual fund or a US exchange-traded product, in which case those rights of that investor and what levers that investor may choose to pull to seek redress for losses may be purely domestic US levers. And similarly, you could have asset managers in England who have similar structured products that give investors exposure to these emerging market instruments, but the law and the domicile and the jurisdiction for resolving those issues could well just be the courts of England. So you have emerging market problems being worked out through very domestic courts in the US and Europe. It really starts with assessing the risk. And you have to assess both the direct exposure that we talked about, where you are directly a lender, for example, to some of these issuers. But you also have to identify the indirect risk. And the indirect risk could arise by the fact that you are a placement agent or an underwriter for one of these issuers. The issuer is offshore, maybe far removed from the jurisdictional reach of US courts or English courts, but you as a financial intermediary are very much subject to jurisdiction in those places. And all of a sudden you find the ire and the interest of investors focused on you as opposed to the issuer who has defaulted. I would throw that in the category of indirect exposure, but that's just the beginning of indirect exposure. In addition, there could be indirect exposure through mutual funds, exchange-traded funds, various kinds of investment products that have either been structured and marketed by the financial intermediary or that have been the subject of investment recommendations through a wealth management business or an asset management business, for example. So it's assessing what the risks are. Two, getting a better understanding of how you communicate with the constituents, with your customers, with your regulators, with your shareholders, about what those risks are and how you are planning to manage those risks. Three, dealing with the claims that are almost certain to arise. We have yet to see a financial cycle, a credit cycle, where investors lost money and did not exercise every legal right they could possibly identify and exercise. There will be claims. There will be disputes. There will be class actions. There will be restructuring. There will be bankruptcies. And financial intermediaries are going to find themselves caught right in the middle of all of those developments. So now's the time to start identifying where those risks might arise, seeing if you have the right personnel looking at those risks, and begin putting together a playbook from your perspective of how you will respond to these issues as they arise. We have started speaking with financial intermediaries about exactly those issues, identifying the risks, understanding their documentation. What rights do they have? Where can they have their defenses best litigated? What kinds of levers can they really pull in a restructuring to make sure that their interests and the interests of their clients are best protected? There's a similar set of considerations that I think an issuer has to go through. I know we talked a little bit about investors and financial intermediaries, but if you are an issuer with a very large debt overhang, you may have several series of bonds that have been issued through various jurisdictions, Luxembourg, Cayman Islands, Bermuda, et cetera. You have institutional investors, big mutual funds, asset managers who own tens, if not hundreds of millions of dollars of your notes. And you face unachievable debt burden as a result of falling commodity prices, the slowdown in China, the rise of the US dollar, your own earnings. You find yourself increasingly facing a debt burden that you cannot service. Different issuers have historically reacted to these issues very differently. There were many defaults in Southeast Asia. There have been many defaults in Latin America historically. We are increasingly more globally linked today. As an issuer in a developing or emerging market, it may not be very feasible for you to say, well, I'm going to default on my debt, and if my investors want recompense, they can come to the local courts and try their luck. Issuers cannot think locally. They've raised their debt globally. They have to think globally about solutions to that debt, where they engage and how they engage with their creditors. If you hope to access the global capital markets in the future, you can't simply walk away from your debt obligations. And if you do, you will pay a high price for that in terms of the future growth of your business. Those are the kinds of strategic discussions that issuers need to be having now if they see a debt load that they're going to find it difficult to service in the coming months and years. By some measures, there's several $100 billion of debt that comes due from the emerging market economies over the next 2-year period. And with rising interest rates and a stronger dollar and a changing economic environment, a lot of that debt is going to be difficult to refinance. So the day of reckoning for issuers is fast approaching, and they need to be prepared. They need to be speaking to both financial advisors as well as legal advisors about making sure that their shareholders' interests are protected and that the future strategic growth of their companies is protected by responsibly dealing with those debts as they arise and restructuring them where possible as and when they arise. The way we've approached this looming crisis in emerging market debt is a great example of how we work across offices and practices. One, to identify issues for our clients, get a better understanding of potential solutions to those issues, and then really engaging in a dialogue with clients and prospective clients about how we can help them respond to a looming set of issues. We started following this issue of high-yield debt and emerging market debt several years ago. As the crisis and issues come more into focus, we're not talking about generalities anymore. We're talking about very specific sets of issues. We are putting together various types of playbooks that could be used. And those playbooks are put together by a wide range of Jones Day lawyers. Lawyers from our Amsterdam office, our London office, from the bankruptcy practice, from global disputes, from financial institutions litigation and regulation. Because the solution doesn't reside in any one jurisdiction or any one legal specialty. The solution has to be created and crafted by lawyers working creatively, using all the legal tools available in all the different jurisdictions to find the right set of issues to identify and pursue, the right levers to pull, so you can get the best solution for the client that you represent. And you could well be representing issuers in certain situations, and we could well be representing financial intermediaries and investors in other situations. It's not one size fits all, and what you really need is a firm that works as one firm worldwide, which is what we do.